The S&P market is likely to go higher short term. However, before Thanksgiving, you might want to lighten up your positions a little bit because headwinds are coming. Today is November 11th, and the market is almost closed. We saw some interesting action last week. The market came down hard into Friday, and then it rebounded even faster the first few days this week, almost recouping the full decline that it took from October 28th until the 7th of November. Okay, so the range that we mentioned last time was the upper channel was in the 6950 to 7,000 area, and the lower channel was 6630 to 6680 in the time frame that we're in, where by the 13th of November, we were expecting the last point of weakness. On the way up, you probably have some pullbacks. We went straight up for 2 days now, so it's not likely to do that every day. There's probably a low on the 13th, another one between the 17th and the 19th, as opportunities potentially to buy in on the way up. Ultimately, what's going on is that we're looking at a lot of cycles, and what's clear is that we have, as we mentioned last time, we have a number of them that are simultaneously going up. But 3 in particular are the most important ones that we're looking at. One of them is the 60-year cycle. Another one is an 80-year cycle. Another one is the 36-year cycle. Okay? But what's coming around the bend here is that one of my students, a very intelligent student, came to me and gave pretty good evidence why the 60-year cycle is either topped or very close to topping. And if you look at the pattern recognition program, on the daily chart, it actually looks like it could be near a high, very close. And on the weekly, it looks like it may be a little bit later. But nevertheless, astrologically, the 60-year cycle is one of our drivers, and that thing is topping out. And if so, why are we still bullish? Well, the reason is the 2 other cycles that we're looking at, the 80-year cycle, 36-year cycle, and some of the shorter term ones, including the 261 trading days times 6, which we mentioned last time, they go up higher into the spring. However, what you should recognize right now is after this rally that's shooting out of there last few days, we'll probably go up into the Thanksgiving area. But the early part of December, potentially all the way until late January, even early February, some of those cycles turn down and they have enough of a correction that you don't want to sit through it unless you're a very long-term investor. Okay? So starting right around December 1st, I would say you want to lighten up, or even right the day before Thanksgiving, you want to be lightening up your position unless you want to sit through what could be a 5 to 10% pullback between December, or in one case it's December, another cycle says it's in January. The 4-year cycle tops out in January. So you don't want to fiddle around. If you're a short-term trader and you're trading short-term swings, this rally that's happening right now, you want to enjoy it, and potentially we will take out the highs that we made at 69.55 on the futures. Right now we got up very close today into 68.76, I think. We're very close to a top here, but to the last top. However, we're probably going to take it out. We probably will go up to the 7,000 area, which is a psychological resistance area, and there's some planetary resistance up there as well. And then I think we'll pull back early December, possibly for a week or 2, and then possibly go up again into early January. But January could be down also. So between now and February, we could see some really rock and roll in both directions, none of which means the market is in a bear market, at least not yet. After the spring, however, either March, April, May, somewhere in that window, we're expecting the final high. And after that high, we expect to see a bear market the remainder of 2026, potentially into early 2027. Because then the cycles that have not yet topped, then you have the 3 major ones all down. Also, just a reminder, this coming Sunday, the 16th of November, we're giving our market forecasting masterclass, our last one of the year, and it's going to be great. We're including in this course a number of trading systems that we have been giving the students, and signals on those systems since June have been extremely profitable. And those are available to the students, as well as our Discord group is an extremely vital, energetic, supportive interaction between a number of students who are in there, and some of them are very talented and very profitable. So anyway, it's a great course. If you're interested, there's information directly below this video. What's also interesting is the 79-year cycle, 79.8-year cycle, which is January 23rd of 1946 right now, is repeating at a 95% clip accurately, 95% correlation the last 6 months. It's exactly 3 times 26.6-year cycle, which was the tech bubble in 1999. And the tech bubble in 1999 still has more to go on the upside, but it doesn't go straight up at this point. It kind of chops around. The 1946 market chops around for a month or two, and then it shoots up higher. And so this 79.8-year cycle, about 80 years, it turns out it's not a recent thing. We've been watching it. The 1942 low lines up with our 2022 low, and there was a rally from 1942 to 1946, and we're in the tail end of it. And we had a rally from 2022, and it's going to end, looks like it will end in 2026. And that's not an accident also. There are multiples of 26.6 years that are also in the market. And that was what happened in 1999. In 2000 was a high. And that would line up with 2026 as well. 1972 is 53 years. That lines up with the 1973 high in 2026. So we have multiples of a 26-year cycle and a roughly 80-year cycle are, they're all playing out right now, and they have been for years. So the 60-year cycle, even though it is probably topping, is not the only game in town, and the others need to be considered as well along with it. It seems as if that decline that came in between the 28th and the 7th was deeper than we expected, although it did stay in our channel that we expect. The lower part of the thing was right on our lower channel, right on a trend line, right on an Andrews median line to the tick. The low came in perfectly on that regard. But even so, it was deeper than expected, and it also indicates we're probably in a corrective move that started. The rally is in the middle of this rally, even if it makes new highs, is in the middle of a corrective move. And the remainder of that correction will take place in December and January, after which, probably, if this is a 4th wave on some large scale, we'll probably see a 5th wave rally making significantly new highs by April of next year. We're still looking for 7,600. From 7,000 to 7,600 is like 10%. To go another 10% above the highs is not that hard to do, particularly since the time is, you have another 5-6 months to do it. It's not likely we're going to do it this quickly in November, however. And it's also possible in December it'll kick back enough so that we won't do it in December either. All right? Okay. And so in the context of our overall view that the market's going to trend higher over the next 5-6 months, and that it may not go up every month. As a matter of fact, December may have a dip in it, and January may have a dip in it. We don't recommend going short against this market. Even if you were an extremely talented trader, it's extremely hard to catch it exactly. And worst part of it is, even if you get short and you start making money, you don't know when to get out, and then the market will shoot back up in your face. And it's a hard thing to do. I wouldn't recommend doing it. If you want to lighten up your long positions, that makes sense. If you're not wanting to get out, you can hedge your positions for a few months and until February, and then you could exit the hedges for the next final rally, which we're expecting next year.